us on the show. Go ahead.
Okay. So, well, looking at numbers that TCI posted, we have Vineet Agarwal with us on the line. Let's just quickly run through the numbers before we get the conversation started. So, for the first quarter gone by, the revenue growth that TCI has put forth is around 10%. EBITDA is up by about 3%. The profit growth is around 11%. Small dip in margins, just about a 50 basis points dip. Margins have come in at 9.9%. This is, of course, a year-on-year comparison that we're doing right now. Mr. Agarwal, great to have you with us. Can you just start by outlining what the trends are like and, just take us through all the three segments? First quarter is done. We're practically, getting over the second quarter as well. Where do you see sluggishness and where do you think is the bulk of the growth going to come from this year?
Hi, always good to be here. Usually the first quarter is the weakest quarter because, typically after you're coming off from the March quarter, which is really, really good, things tend to slow down a little bit. We have, for example, in the automotive sector, there's a lot of stock that is still there, and that stock is not moving as fast as it should have. So there is a collection of that material that is happening. Simultaneously, in other sectors, so if I go division by division, freight business did reasonably well. However, the LTL business has not picked up as we expected because MSMEs are still not there yet. I think with the elections in the first quarter, things were a bit slow. There was a little bit of less buying, and also orders were not flowing through completely, as in money was not being transferred as much and flowing through the system. On the supply chain side, generally, things were good. We've acquired a lot of new contracts, especially in the automotive sector, as well as in the warehousing business. So both of them are looking very attractive. In the automotive sector, even though there are some companies that are stagnant in terms of sales, there are new companies that are coming up. For example, in the EV space, and there we are doing a lot of transportation for them, using both road as well as rail. The seaways business did reasonably well, much more than expected. We had 2 ships that were in dry dock in the first quarter. Even then, freight rates have firmed up. Actually, what has happened is that with the Red Sea crisis and international freight rates moving up, some of those ships have actually moved out of the domestic sector into the international sector, which means that the domestic freight rates have firmed up. Simultaneously, bunker prices, that is the oil prices, have also firmed up. So that led to an increase in rates. We were able to keep up the voyages as we had in the previous year as well. So that has helped that business. Net, it has been a much better quarter than expected, and the guidance continues for 10 to 15 on the top line and 10 to 15% on the bottom line.
10 to 15% on the bottom line. I think in the last conversation you had spoken about 10 to 11%. So is there scope to push up margins all the way to 15%, or you're just giving a wide range?
Well, there are lots of uncertainties that always are in the marketplace, especially with the crises that are happening overseas. So that tends to affect the margins a little bit up and down. We are looking at positive territory, so I would be confident to say that 15% is more likely.
Okay, and even on the top line, do you think you will be able to push closer to 15%? Because last year you managed only a 7% growth and Q1 has been 9%, so still not in double digits.
Yes, I think if you see the general trends that are there, typically in now onwards, we'll see festival season, really the stocking that starts happening now, whether it is the consumer sector, whether it's automotive, those will start playing out. Then we see the budget has been good in terms of the flow towards infrastructure spend will continue. So that trickle-down effect, which is a 3.5 times effect of any infrastructure spend, that should help as well, capital goods sector and the related sectors. Apart from that, there is hopefully by maybe with the monsoon season being good, we should see again a better pickup overall. So capacity expansion and private capex should also start coming in. So that means that we should definitely start looking at a higher growth rate for the quarter. We are directly linked to GDP growth as a logistics sector. So we feel that there will be definitely some pickup in the second half of the year.
Okay, so sounding fairly confident of maybe 15% growth rates at the top line and the bottom line level. Got that. Speaking of capex, what about your own plans? I think the earlier figure that you've shared is about 275 crores. Does that stand, and what's the progress?
Yes, the capex is about 375 crores for this fiscal. This included the acquisition of two ships, that's the order of two ships that we have just placed as of last week. These are two ships that will be ordered in China, and they will be delivered sometime in the year 2026. So some advance payment for that will happen as well. Simultaneously, we are also investing into trucks as well as warehousing space and, of course, containers and the like. So the 375 crores stands. I think we'll be around 350 to 375 crores this year.
So, Vineet, just a question. Since you're adding more capacity on the seaway side, you're getting these ships in. Say by the end of the year, what's the revenue mix that you would hope for? And I think more realistically, let's talk FY26 because that's the highest margin business, right? That's where margins go as high as 27, 28%.
So, well, this year's revenues for the seaways businesses will be almost the same as last year, or maybe slightly better. But we don't expect the capacity to come in, as I said, till 2026. So then definitely there is this is about a 20% expansion in capacity. But notwithstanding, we are also looking out for a second-hand ship. Since the markets are very hot right now globally for shipping vessels, we are still waiting to see for it to cool down a bit and then acquire another vessel in the next few months, hopefully. So if that happens, then capacity expansion by 2026 should be in excess of 30-40%. But also some ships will go out of service because they will get to the end of life. So 25% capacity expansion would definitely mean a 25 to 30% jump up in revenues by 2026 for this division.
Thank you, Vineet, for joining in. Now we'll get into that break. But